All right, today we're doing a deep dive analysis on a company that's been a cornerstone for many income investors in Singapore, NetLink NBN Trust. Think of it as the foundational plumbing of the nation's internet. For years, it's been seen as a bond proxy, basically a super stable, utility-like investment you buy for its reliable payouts.
But here's the big question we're tackling in this explainer. Is that stable growth story at a turning point? You know, the latest financial numbers are starting to show some cracks in that smooth, predictable facade. So let's really dig into the data and see what's going on.
So here's how we're going to break it all down. First, we'll lay out the classic investment case for NetLink. Then we'll look at the new data that's signaling a potential shift. After that, we're going to go beyond the headlines to look at the real financial truth, the cash flow. And finally, we'll frame the bull versus bear case for where things could go from here.
To really get a grip on where NetLink might be heading, we first have to understand what it's always been: a super resilient, incredibly predictable, utility-like business. For a long time, this was the absolute bedrock of the company.
I think this image is a perfect metaphor. Think of NetLink's fiber network like these deep roots. It's the essential, buried infrastructure that the entire digital economy is built on top of. This creates a massive barrier to entry. I mean, who else is going to build another nationwide fiber network? It's a powerful position to be in.
And this table right here, this shows you exactly where that rock-solid stability comes from. Just look at this revenue breakdown. The huge majority of it, from residential connections, non-residential, you name it, is recurring and regulated. Residential alone is almost 60% of the pie. This whole structure is engineered for one thing and one thing only: creating predictable, long-term cash flows year in, year out.
So what does that mean for investors? Well, it means this: a beautiful, consistent history of growing distributions per unit, or DPU. You can see it right here. It's just a steady climb, from 4.88 cents back in fiscal 19, all the way up to a projected 5.36 cents for fiscal 25. This track record is exactly why it earned its reputation as a go-to for reliable income.
Okay, but that's the historical view. And that history is now being put to the test. Let's pivot to the recent data because it's pointing to a pretty significant change in the company's performance.
And boom, here is that inflection point, clear as day. On the left, you've got the first 9 months of fiscal 24. Everything looks great. Revenue's up over 3%. EBITDA is up almost 4%. Healthy growth. Now look at the right side, the same period for fiscal 25. The story has completely flipped. Revenue is now slightly negative, and this is the real kicker: EBITDA has dropped by over 5%. That's not just a slowdown, that's a reversal.
So why the big drop in EBITDA? Well, here's the culprit: margin compression. In just 1 year, the EBITDA margin fell by 3.4 percentage points. It went from a healthy 73.8% all the way down to 70.4%. Now, for a business that's built on stability, that is a sharp drop. It's a huge red flag that cost pressures are really starting to bite. And at the very same time, the company's debt level is on the rise. Net gearing, which is just a key way to measure debt, jumped from 24.3% up to 30.6% in just a year. Now, the company says it still has plenty of debt headroom, and that's fair. But for analysts, any change in the financial risk profile of a company like this is definitely something to watch very closely.
Okay, so we've got declining earnings and rising debt. That sounds pretty bad, right? But to really understand if this is just a temporary blip or a more serious structural problem, we need to look past the accounting noise. We need to find the financial truth, and that always lies in the cash flow.
Now pay close attention, because this slide is critical. On the left, you see the headline number that spooked the market. Profit after tax was down almost 13%. Ouch. But look to the right. That's the financial truth. The actual cash the business generated from its operations was still a massive $182.5 million. So what gives? How can profit be down so much while cash flow is still so strong?
Well, the answer is really in the fine print. That year-over-year comparison is a bit misleading. Yes, operating costs were a bit higher, and revenue from smaller projects was lower. But the real game changer is this third point, a one-off item. See, in the prior year, the results got a $6.2 million boost from a reversal of some old power charges. That one-time gain isn't there this year, which makes the comparison look way worse than the reality. The core business is still an absolute cash-generating machine.
So when you put all of these pieces together, where does that leave us as investors? Well, the data really supports two very different, competing stories for the future of NetLink Trust.
Okay, here's the showdown. The bull case is straightforward. The business is fundamentally strong, you've got resilient, regulated cash flow, it's essential national infrastructure, and you're seeing growth in new, higher-margin areas. Plus, you can't argue with that history of steady DPU growth. But the bear case is just as compelling. They'll point to the sustained pressure on margins from rising costs, the increasing debt, a residential market that's pretty much saturated, and less money coming in from those one-off projects.
And this all boils down to one final crucial question. We know NetLink's roots are incredibly strong, but we also know its core residential market is maturing. So can its new ventures, all those high-margin connections for businesses and smart nation projects, can they grow fast enough to offset the very real pressures on its legacy business? That is the inflection point the entire market is watching right now.